Welcome back to the afternoon session. I hope you've had a good lunch break. As you can see, our panel discussion for the next session is about to begin, and they're ready. Thank you so much, delegates, for making time and being quite on time. So I'll just hand it over to Johnston Oltetia. He had come to the podium previously, so no need to introduce him again. They're going to be looking at innovative strategies for offtake. We're just trying to find solutions to the challenges we had discussed earlier. So this is our first session. Welcome, Mr. Johnston. You can take us through your panelists and begin the session. It's going to be 40 minutes. Thank you.
Thank you, Beatrice. And she's cutting our time by 5 minutes. It's supposed to be 45, right? Anyway, so this is extending the access frontier for housing finance, innovative strategies for offtake. Now, so we have an exciting discussion this afternoon, and it's going to be practical. We have 6 practitioners who are going to be taking us through some of the innovations we're having sometimes I think we can say overcome some of the challenges we face on the supply side. So this is pretty much a supply side discussion. And of course, you know the challenges we face cut across. It cut across financials like us in KMRC, developers, and government, and a number of other practitioners or stakeholders on that part. Now, I'm just going to set the context before I go into introducing the panelists. Now, when you talk about affordable housing in Kenya, this started, I think, to take root mainly in 2017, when we had what was initially called by the former government the Big Four agenda. Now, at the time, it was contemplated that we'll address both the supply and the demand side of housing. The demand side of housing, the intervention actually was KMRC to provide long-term finance to enable end users to access affordable financing. And you know what? There are 2 key issues that underpin public housing policy, and that is affordability and accessibility. Accessibility is matching what is required and what is available. Affordability, on the other hand, is something to do with income versus the costs. Now, when you look at that, you note that both the supply side and the demand side of housing have to move in tandem. If one moves slower, we have a problem. And that's precisely what we're going to be discussing here. So the intervention on the supply side that was contemplated by the Kenyan government at the time didn't work. And it was actually development at an institution called National Housing Development Fund. And that is an institution under the National Housing Corporation. On the other hand, the demand side is KMRC, and I think that one has fairly moved well. But of course, it will not be doing very well unless the supply side is equally fixed. So what happens? We couldn't get construction finance. We couldn't get affordable development finance. And that essentially affects demand. And that means demand will only move at the speed of the supply of units. And that's where we have a challenge, particularly demand on the lower side of the market, because of course we don't have a problem with the upper middle income part of our market. I mean, you see units coming up from time to time. So people resolve to buy homes on cash basis. And the problem with that is that then you don't have scale. So for us to look at that critically, we have this exciting panel. Like I said earlier, they are practitioners, and therefore we are going to get insights from them on some of the innovations we're having from each of them to support the offtake or that development. I know at the moment in our country, of course, you know, a majority of us have seen the finance bill, And what does it have? It has some very unpopular proposals, not least one that was discussed in the morning about a housing levy. And you know that's not new. The first time a housing levy was introduced was actually in the Finance Bill of 2018. And to cut the long story short, it actually passed into law. And of course, it didn't just pass into law, it was forced to pass into law. But what happened? People usually have recourse. They went to court, the unions, and they stopped it. Now, it has since been introduced. At the time, it was actually 1.5% of your gross income, and to be matched by your employer. Now, it has come back, I think in a big way, because now it's 3%. But why don't you guys want to contribute for us to construct houses? Don't you just want to help to develop homes? I thought you'll be very glad to say, you know what, we need construction finance, we need development finance that is affordable. Anyways, to cut the chase, I'm just going to introduce the panelists. My panelists here. We have Melissa McLean, who is the investment manager at IHS. Melissa is just at the corner. We have Lucas Mbugwa, who is the head of corporate planning, Mivida. Mbugwa is just next to me. We have Jean Vima, he's the director of East Africa Strategy Consulting, and Jean is right across. We have Zara Kanbai, who is the head of commercial property finance East Africa at APSA. We have Tom Onyango, he's a senior partner, head of real estate banking practice, Triple K Law Advocates. And then we have Lee Peng, who is the co-founder and managing director, Endeavor Construction Company. Welcome, ladies and gentlemen. So we're just going to start with, some sharing of insights on a couple of the issues that we're handling right now. And I will actually start with Jean Vima. What is your view of the OFFTAKE problem across the region?
So thank you for asking. So generally speaking, that's a problem for most government and developers, not specific to East Africa region. It's critical to understand that housing is not cheap anywhere. So especially in urban area, given the associated island costs. So owning decent housing is a lifelong endeavor for most households, given the income level. So the main reason for low offtake can be identified as being, first of all, limited income base. Second, informal job and informal revenue stream. And third, inconsistent revenue stream for the households who are in the target segment of affordable housing, for example. So, to be honest, it's a problem that the private sector cannot really solve on its own. It needs public intervention somehow through banking system, of course, but also through development funds and dedicated institutions.
Very well, that's true. So neither government nor private sector can actually solve the problem alone. Now, with that kind of thought, I just want to follow up with Lee on how is OFFTAKE an issue for your company? How do you ensure a market for your units?
Yeah, for the successful business, you really need to find the off-takers before you launch the business. That's what my strategy is. For my experience, we started doing the construction sectors for 5 years in different areas, and then we've been participated in both public and private affordable housing. Especially, we did 3 projects with the National Housing Corporations at Estonia, and Kibera, and Kisumu. So we find out the design was really old school. The design from the government, they never changed. They've been using the same design for almost 10 years. So we're really not following the trend of the demands from the different regions. So that's why after I've been doing with them, then I started my own project as a developer. Then I did an adjustment to the size and also especially for the pricing. Because of the pricing, my price, I can't say it's lower, but it's very competitive to the government affordable housing. Because they are they're trying a lot of those innovative materials, which is really hiking the cost. So for me, the point is, for getting the customers really look at lower the cost of the project. So then you can make sure it can be sold. And the second thing is you have to make sure that the house can be completed. Because in Kenya, the greatest fear for most of the clients is they buy a house after 2 years, they cannot be delivered. That is I cannot say 70%, but at least the certain percentage which is happening. Then, because once you can fulfill one of the project, complete one, then you will have loyalty customers following you, no matter what kind of design, size. Of course, pricing is the matter, but as long as you can finish, that is the first priority of what they're thinking about. As long as you can do both pricing and the deliver on time, you are sure the customer will come.
So delivery is key, and I think we all know, particularly in Kenya, off-plan has been a problem, right? It has a very bad name, and that has been contributed by a couple of people who are not in this room. But if that is the case, Zara, what has been the challenge for banks in financing affordable housing? Is delivery the key problem? What are the constraints to commercial property development?
Yeah, thanks, John.
Some entertainment.
Yeah, thanks, Johnston. So I think, in my opinion, I think the real challenge for banks has been around our ability to test the market's appetite for a product like this, really when you're looking at vetted pre-sales. I think it's a no-brainer when you look at the sale proceeds being really the exit for any financier, right? But I do think the Kenya market is unique, and the reason why I say that is because the offtake market, or the offtake risk, is elevated a lot more here, really because we don't have a robust mortgage market, and I think that's come out quite clear during the conference so far. And really what we're seeing instead is that the demand for these kind of units is really coming from people who don't have a structured salary, right? I think the second nuance that we're seeing, and this could be a cultural thing, but there's some resistance in off-takers in committing the full purchase price for a unit, either completely off-plan or even midstream through a development. They like to see some physical work going on site before they put their last payment down. And I think the third nuance that we're seeing in the Kenya market is that there's really no restriction by developers in using pre-sales towards completing the development or towards development cost. And from a development or a developer's perspective, it makes absolute sense considering it's the cheapest source of funding, right? But when you look at these nuances, for a bank to come in and then structure a facility, it does add an element of complication. And what do I mean by that? So if you look at the traditional sense of funding a residential development, on one side you've got your cash buyers who have parked their money, the full purchase price, they've parked their money in an escrow account and it's sitting with the bank. On the other side, you've got approved mortgage facilities. So from a bank's perspective, there's an element of comfort in having sale proceeds locked in. There's a clear exit for any financier, but I think more than that, it actually illustrates a level of demand for that particular project, right? So there's some comfort that that project will actually be successful. And when you have this playing out the way it does, again, the bank has a lot of comfort in looking at the capital structure. So you've got developers, who have put in their equity, you've got the bank who then comes in and puts in the debt funding, and you get a complete project. But again, in a market like this where developers choose to use pre-sales and rely a lot on them for the reasons that I've mentioned earlier, then it adds an element of uncertainty into whether the capital structure will be sufficient to actually complete the project. So that adds an element in there. Just on my last point, I think we've seen a lot of developers try to compensate for the lack of the mortgage market, or where access by off-takers hasn't been easy, and that really is where we're looking at the rental model, which has worked quite well, or the TPS arrangement, which I think the panel will speak to a little bit later. And one of the challenges that we're grappling with now is to say that, if a developer has put together their model, they really want to exit between 24 to 36 months. They're not really taking a longer term view. And more often than not, the bank will actually walk alongside that model, in summary.
Absolutely. And I think you're talking about having or lacking a salary, and of course the informality of income just becomes problematic for a financial institution to finance. But do you agree, Melissa, what is the main criteria in affordable housing that drives demand, particularly on the lower end of the market?
Thanks, Johnson. Apologies for that little incident. I thought I'd just wake everybody up. Just to give a little bit of context first, as IHS, we are a private equity affordable housing asset manager. So we have a presence in South Africa, Botswana, Namibia, and now in East Africa. We've just recently launched our first affordable housing fund in Kenya. So what we typically look at in South Africa, and this has been our methodology across different continents and countries, is that we look at affordability, product, and location. Affordability is largely driven by the market fundamentals of the end user that we are targeting. And we're typically targeting the lower to middle LSM end user. And as IHS, we find that the product needs to meet the end user requirement and not the other way around. We don't first develop the product and then try and force the end user to afford it or accept it. So we've spent a lot of time trying to tailor make the product to suit the end user's affordability. And in terms of location as well, what's very important to the lower end of the market is having access to basic services, amenities, convenience, and all of that. So what we're trying to bring across in Kenya is pretty much the same model. As Zara mentioned, the mortgage market is still very much underserviced here. I read somewhere that we have about 26,000 mortgages actively in this market, and that's 0.05%. I actually worked out of the population size. I think there's a very large informal market, mostly from a rental perspective. So we as IHS, through our Kenya Green Affordable Housing Fund, we want to stimulate demand for an affordable product. We want to try and encourage more offtake from developers. We're obviously working with turnkey developers like Mivida, providing offtake to them. We want to partner with developers, take development risk. And the idea is to try and structure an affordable product that will allow end users to actually access mortgage finance at a more affordable price. And later on, I'll speak about how we actually intend to accomplish that. Thanks very much.
Thank you. Building partnerships to support supply. And that includes working with Mivida. So Mivida, and this is Lucas, Mivida Homes is relying upon a tenant purchase scheme to enable households to ultimately purchase housing without a mortgage. Would you think that approach will work?
Just to give some context around Mivida's strategy on the tenant purchase scheme. Mivida was formed in 2018 as a joint venture between Actis, one of the largest private equity funds in the world, and Shapoorji Pallonji, which is one of India's largest contractors, with the aim to solve the home ownership problem by playing within that affordable and mid-market space in sub-Saharan Africa. What we've noted in our project so far, so our flagship project was at Garden City, Mivida at Garden City, where we've sold 75% of our stock. And we've noticed that most of our buyers tend to be investor buyers. We've also launched an affordable project in Garden City called 237. And again, similarly, we've noted that most of the buyers are investor buyers. So for us, what we're trying to do now is to widen the pool of buyers, and not just focus on the on investor buyers, who tend to be Kenyans in the upper middle to upper classes, who have the cash flows that are necessary to make the installment payments during construction. So some of the strategies we've looked at, as Melissa has alluded to, is bulk offtake deals, where we sell a significant portion of our stock to the likes of IHS. We've also then focused in on tenant purchase schemes to solve some of the gaps in the market, due to the lack of access of mortgages. So when you look at our TPS, what makes it so attractive in the market? When you compare with mortgages, mortgages tend to be quite expensive in our market. So at the moment, I believe I've seen rates from 15 to as high as 20%. In addition to that, they are variable. I know in the 90s, they hit the 30s percent, and from our fathers, the advice is always don't take a bank loan. You never know where it could take you. So these are some of the challenges that we're trying to solve with the TPS. So our TPS, we're looking at a fixed rate of 13%, and this is off the back of discussions with various CDFIs and even KMRC here. And if you, and when you make a payment, an upfront payment of 20 to 30% on your TPS, and then pay out the balance of a 15 to 20-year period, you find that the price you're paying on that TPS, the monthly payment, is quite close to rent. I think we've seen something in the region of a 20% premium, which over time we would still catch up with, considering rental escalations. And we've seen this in the TPS schemes that have already been sold in the market, like at Nyayo Estate in Embakasi, where the initial buyers are actually now, are profiting just from holding the units, renting them out and making their payments, because the rent now is over and above the TPS payment. Kenya tends to be a hustler economy, and again, mortgages don't look at other sources of income. But with our TPS, we want to look at everything holistically, whether it's formal or informal income, and thus also open up and widen the buyer base to not just the structured people with the structured salaries that Zahara likes. Yeah, and then in addition to that, there are various other advantages to taking a TPS instead of a mortgage. In terms of, in the event of a default, it's an easier conversation to have with a TPS provider than it is with a bank. We won't be as litigious. When you're also looking at possession of the unit, so in terms of a mortgage, you only take possession once the unit is fully constructed, the project is completed, and the charge process is also complete. So with us, you won't go through that onerous bank charge process, and as soon as the unit is completed, you can move in without taking all the other steps. And just finally, on the closing costs, when you're buying a unit with a mortgage, you pay up all your costs upfront. So this is your stamp duty, your legal fees, and the likes. But with the TPS, the transfer of ownership only happens at the end of the 20-year payment period, and that's the point at which you'll then be making those quite substantial payments. So just to conclude, I think historically we've seen quite a deep demand for TPSs. Whenever they've launched, whether it's through NHC or NSSF, by the time you find out about it, they're already off the market, and they've been sold, too quickly. So this is just a reminder to move with Mivida. We're selling the tenant purchase schemes, and there's an opportunity for you to make some money on that. But also, it just shows that there is indeed demand for such products in the market. Thank you.
Absolutely. There is always demand for tenant purchase. But don't take the grandfather advice of not taking a loan from a bank. It's no longer holds. So, and you know what? Financing a home with cash is inherently inefficient. It's actually terribly inefficient to use that kind of approach. But having said that, Tom, there are legal and regulatory challenges in the affordable housing space. Tell us about them.
Thank you. You know, when you think of Kenya as a market, you know, we've got all sorts of statistics about the market, and we say the deficit for housing in a year is 200,000 because we need 250,000, and we build, give or take, 50,000 in a year. So those figures look good for an international investor because you think there's potentially a big gap to be filled, until you realize there are two problems here. First of all, we have a national government, and I think the moderator has spoken about the moves that have been made towards forcing or getting Kenyans to pay 3%. If it's passed into law, you have no choice. But, so in addition to the national level, the problem from a regulatory perspective is that you've also got 47 county governments to deal with. So that national figure of 200,000 deficit in housing, it's not going to be fulfilled just in Nairobi, where you then have one county government to deal with, but you've got 47. So we've had situations where you've got clients who think of that, filling that market potentially, but then when you're advising them, you need to think, fine, if I want to do this, replicate whatever I want to do in Nairobi in smaller scales in each of the 47 counties, what are the regulatory issues? But what has been touched on before is the current finance bill 2023, but that's been preceded, I think, all the way from 2004, when the government started first looking at housing for civil servants. In every subsequent year, there seems to be a tweaking of the regulations and the laws regarding this whole issue. How do you get funding? And I think the question that we need to deal with as a country from a regulatory perspective is, do you want to go to a system that is voluntary, where we facilitate those who want to buy property, or do you want to go to a situation where we say, we create a fund and then find a way of distributing that fund to those who are creating? Because it's not necessarily that the people who are paying into the fund are the ones going to benefit from it. I think that the thinking around there needs to be sorted out. I understand there are about 2.9 million Kenyans in salaried employment. Out of that 2.9 million, the average, from the research I did, the average income of those is about 72,000 shillings a month, give or take. And so if you're going to contribute the 5%, the figures I was looking at is about 2,600 per employee per month. It sounds good. It sounds good, and I think it'll end up with a big fund if it is implemented properly, and if you deal with the issues which I've mentioned earlier regarding regulations. Because yes, if you're sitting on a large pool of funds, you really want to be able to deploy it very fast. But if you go to negotiate with so many entities, that is a challenge. And I think it's something that maybe we need to think about national standards in some areas, so that you reduce the amount of legwork that a developer has to go through to be able to put out the units which are required. The market, the potential is there for a big market, but in terms of implementing it and actually delivering on the units, as I say, you have got the regulatory problems, both at the national level, where you probably would want, as a developer or as anybody in this market, stability, so that you are able to project that the law won't change every year. If you can even have a 5-year horizon. Currently, it's very difficult to get a 5-year horizon because of the constant changes. And yes, the law gets tweaked every year, but the fundamental basis of it should not be changing so fast that you cannot plan on the basis of the law. And I think anybody who's investing would want a situation where I can predict, if I start putting up these houses now, if I start planning now in the year 2023, by the time I'm delivering them in 2025, the law will still be the same in terms of who my potential buyers are and how I can sell, what the rate of interest it will be. All those regulatory issues, even in terms of building permissions, because that now goes to the counties, and how they deal with the permission to build. If you don't have stability there, that is a major problem for anybody who's putting money into an economy. And then, therefore, it means that you're then able to, only able to take small chunks that you can deal with. While, if the situation was a bit more stable, you'd be able to expand that significantly across the country. Thank you.
Thank you, Tom. And I'm actually told that the housing levy didn't work well in Nigeria. I was having a conversation with my counterpart from the Nigeria Mortgage Refinance Company, and it didn't sound very positive. That's not to discourage anyone, but now I just want to go back to Lucas and about supply. What challenges do you face in delivering quality of affordable housing?
Thanks, Johnston. So I think that the main, it basically boils down to cost, right? Because you need to, at least for Mivida Homes, our brand is synonymous with quality. So whether we're looking at affordable homes or mid-market homes, we still want to maintain a level of quality in all our projects. So this, again, boils down to just a question of cost. And if you look through the various sort of categories that make up that cost, I think there's avenues within each of them to bring it down and thus pass on that cost to your buyers and be able to keep within that affordable range. So, for example, if you look at your land costs, so one thing that's challenging there is that because of the low ticket prices, there's only certain areas where you're able to carry out your developments, and you tend to be pushed out of the prime areas, in finding such suitable land. One way in which we mitigate this, at least that huge initial cost of land, is by partnering with, through joint ventures with landowners, and then pushing down your land payments, either as equity or units at the end of your construction, which reduces your need for equity and thus your need for higher margins to preserve your shareholders' return. In terms of infrastructure, you'll find again, as you're forced to move out of sort of the prime areas, you need to do a lot more of infrastructure upgrade, or even setting it up in the first place where there may be none. Again, this is a high cost. What you can do there, or what then the developer has to think about is the economies of scale, by providing a lot more units and sort of keeping the amenities and infrastructure spend to support a lot more entities. You're able to carry that cost, or on a per square and lower it on a per square meter basis. There's also the issue of rising construction costs, of course, with all the hullabaloo in Ukraine with the Russians. So that makes it quite challenging. And also at Mivida, all our projects have a certain level of amenities, right? So you'll find we meet ESG standards, we're FCH certified, you'll get your solar panels, you get your large windows to give you lighting. Obviously, this helps in the long run to keep your operational costs low. But in the, from a capital expenditure perspective, this can be high and prohibitive. On this, I think what the market is lacking is commercially incentivizing green loans. We've seen some loans, but none of them are too different from what's already in the market, at least in terms of that subsidy. And then on the other side, it's the cost, your capital stack. So with the rising cost of debt, I believe now, Zahara, we're around 15%. So you're forced to move more to pre-sales, which means then you have to design a product that will move fast enough and that you can collect on quickly enough, so that you have significant collections within your construction period, which you can then use to fund your project And as Zahara had alluded to, that's at a 0% cost to the developer. So I think in short, those are sort of some of the challenges we're facing and how we're trying to solve for them.
Thank you, Lucas. It's quality versus cost. In Kenya, I don't know whether it's only Kenya or elsewhere. They say cheap is expensive. I have no idea what that means. Now, Lee, does OFFTAKE impact on your ability to raise capital?
And yes, for the off-taking, actually from the historical records we generated from the previous projects, the pre-sales, which only take 30%, and from the beginning, from the beginning of the construction to the end of the completion of the construction, which will only contribute about 25 to 30% of the project cost. So which make us, we cannot rely on the pre-sales at all. So for us, for my company, we actually need to then contribute the own equity about 30 to 40%, and another 60% came from the financing of the finance from the banks, and the pre-sales will only contribute to reduce the interest we are paying, because for the pre-sales, as long as we get a loan from the bank, we come to the escrow account, we only reduce the interest of the project. So for us, we're thinking for the project, before the project to take off, we need to really assure the money is allocated either from bank side and also the own equity side. If it's not ready, should not start the project, especially under this kind of economic climate. So if for some project which already started and find the sales is going slow, and then the material price is going up, the original budget cannot cover the cost currently. I think the best solution is just downscale the project size. But at least as what I just stated before, completion goes to the first, because with the working in progress project will not generate any profit for bank, client, and the development itself. It cannot be rented, it cannot be sold. So make sure the completion, we have to make sure the completion goes to the first.
Super, very well. So now on just going back to Jean Vima, what innovation strategies can we employ to enhance OFFTAKE across the region? So we're not very specific about Kenya, we're just talking about the region.
Okay. First things that come to mind will be guarantee offtake from public institutions or governments. Another point could be project financing without guaranteed offtake. Also, we can think about a rent-to-own model, which is working pretty well over the years. And the fourth will be a build-to-rent model, so which solve problem of housing, but not the problem of property ownership, right? So at a long term, that leave an issue for society to deal with later. To be more specific with an example, a significant proportion of the region population is informally employed. So as such, they are excluded from the bank traditional practice, right? That is granting housing loan to those who can't provide proof of income. So Morocco share some kind of the same markets. So in Morocco, this problem has been solved or resolved more through the Fogarim program. So it's a mortgage guarantee program by the Moroccan government that started in 2003. And the meaning is to open access of housing loans to those who work into informal sectors. So the meaning is to transfer a large part of the bank risk to the government. And on that regard, that will help most of the people to get access to loan and at the end of the day, get access to housing.
Thank you very much. And that is incredible because, you know, the next frontier is for us to go down market, particularly to the informal sector, and finding ways and means of enabling those people who have informal incomes to get housing. Having said that, and looking at the informalities, which creates challenges of affordability, Melissa, does that challenge, how do you deal with a challenge of that kind?
We arm wrestle with developers, specifically Mvida. I think our strategy has been to standardize our product. In South Africa, Namibia, Botswana, and even in Kenya, we've developed a standard affordable housing product. And as our MD mentioned earlier, the size ranges from about 50 to, say, 65 square meters. We even have a one-bed typology, which could be about 40, 45 square meters. So we've standardized our product, we've standardized our spec. Our units are also EDGE certified. I won't go into detail. I was warned at lunch not to give a seminar on EDGE and what that entails. But essentially, through standardization, we've been able to do proper costing on our product, getting independent QS to cost it and come up with the most cost-efficient solution for the end users so that there's economies of scale across different projects. And if we work with reputable developers like, for example, Mvida, you know, we would very much like them to adopt our standard product. Sometimes we encounter developers that already have a design, but we would then work with them to actually, you know, tweak whatever we can on the spec or design to just bring down the costs. And I think in that way, we can actually stimulate affordability because the first point of departure is always who is the target market and what is their affordability. And we do a lot of market research as IHS in every jurisdiction that we work. Before we actually present a project to our credit committee, we have to be able to validate that the market can afford the product. So I would say with standardization, cost efficiencies, and working well with developers to achieve that. Thank you.
Thank you, Melissa. Standardization, cost efficiencies built into the project. Now, Zara, how does the OFFTAKE challenge affect ABSA business? Do you work with your retail? Does the property part work with the retail to get an end-to-end solution?
Yeah, thanks, Johnston. You know, so I think my earlier point still stands in terms of the off-take risk being the biggest risk to any financier, right? So, you know, since the onset of the property desk at ABSA, where I'm coming in to fund the developer, we've actually worked in very close collaboration with the head of mortgages at ABSA, who I know is in the room here today. So we are working in close collaboration with him to put together a framework that really seeks to achieve financing the entire value chain from the developer to the off-taker, but also mitigate the risks along the way. What we're seeing in those discussions is that a lot of developers are asking us to see if we can disperse these mortgages off-plan, either backed by guarantees and things like that, which ultimately really, you know, again, helps the developer complete the project again through the pre-sales that I mentioned earlier. It's the cheapest cost of funding. But what is unique to Kenya, what is unique to ABSA is exactly what you mentioned earlier, and it's you know, ABSA being one of the biggest beneficiaries of the KMRC funding. And while we have had a few disbursements from there, I don't think the uptake has been as rapid as it could have been. And from what I understand, it's, you know, it really is on the lack of having the ready units for them to take up. But yeah, a lot of work is being worked on with the retail team to see how we can solution that end to end.
Thank you. So I'm told we are running out of time, so I'm just going to give each of the panelists 10 seconds to give some closing, but just focus on what we can do differently. Maybe one thing that we can do differently to enhance OFFTAKE. Starting with Vimal.
only once is hard, but
Of the many, just give us one.
yeah, yeah. I have 1 second to think about it. No, that could be, you know, more impact for the government into the affordable housing side of the market, and more investments as a, you know, fund or markets, specific markets pool, if I may say so, that will help a lot to people to get access to loans from banks.
Thank you. Next, so just go around.
Yes, I think for me, I think it's quite clear. I think there's two things that I probably want to see more of. So one, I've got to say two here. So reduce the, one I think is reduce the cost to the developer so they can actually pass on that extra benefit to the off-taker. And I think the second one is that we do need to work quite closely with governments and commercial banks just to really look at a model that addresses the off-takers who don't have that structured salary that I mentioned earlier. Thank you.
Going back to my statement on cost efficiencies, I would say what's important is to understand the target market. And in order to do that, I think not only market research, but economic research is quite important, because in that way you're able to determine what the exact affordability profile of your target market is and ensure that your product is within that range that allows the developer to achieve his margin, and you also allow the off-taker to access funding to be able to access these units. Thank you.
Thank you, Melissa. Lee?
For the view of from the developer and also as a contractor, I think it's about the infrastructure development, because most of these affordable housing was built on the land which the costs is low. The road is accessed, but other utilities which is not available over there, like sewer line, like water supplies, like I think most of them, they don't have a sewer line. So building a sewer, doing a septic tank and also doing the service for them, you're going to increase the cost for management. And once the water is coming just one time a month, a week, then you have to buy the water from the trucks, which also going to increase the cost for the buyers of the affordable housing.
Tom, and I think in your discussion just mention a little bit about consumer protection.
Thank you, Johnson. In terms of consumer protection, let me just quickly say that we have a problem. When you're putting up a development that's going to take a period of time, there's an inherent promise by the buyer that they will pay you in time. And for you as a developer, there's a promise that you'll deliver on time. Sometimes that doesn't work, so you find people with very nice brochures saying, I'll deliver this thing in 24 months. And 6 years later, it's still not there. So that has to be dealt with. So in terms of consumer protection, maybe we need to think of ways in which we can protect buyers against failed projects, but also developers in situations where a buyer is unable to complete in midstream. But on the second issue, if this law is passed that compels the deduction of funds for the Housing Development Fund, my view would be that the best way to pay back to Kenyans would be a significantly lower rate of interest, because that's the only thing that, the only benefit that you can see. So where you would get funding at 15% from a bank, if that can come at even half that, then there'll be a great acceptability. And secondly, reduce the regulatory noise across the country in terms of the frequent changes that make planning very difficult. Thank you.
Thank you, Tom. Lucas?
For me, I'm very excited to hear Zahara talking about off-plan mortgages. I think that's a conversation that maybe we've had before. But I'd like to also extend a challenge to KMRC and of course its partner banks, that I know legally I don't think there's anything stopping you from working with reputable institutional developers such as Mivida Homes. And maybe we can work on a product similar to those off-plan mortgages at the KMRC rates. That would definitely be a game changer. And we've seen this in our with our partners in India. They pre-sell 60% off-plan on the day they open their plans, because all the banks are sitting there giving out mortgages as you book for your unit. So thank you.
Thank you, Lucas, and thank you, panelists. That was an exciting discussion. I just want to wrap up by just highlighting a few things. For purposes of supporting off-plan, I think what I'm hearing is we need to enhance public-private partnerships to enable investments in affordable housing, product standardization to create efficiencies. I think I've heard about pre-sales is an effective way of financing, and that also has something to do with the off-plan mortgages, potentially exploring possibilities of that. And that is reducing developer costs through potentially externalizing infrastructure developments, if government can support that as part of their usual infrastructure, laying out the infrastructure development, and de-risking financial institutions to encourage them to support, lending at the lower level, the non-salaried people. So those are some of the discussions that are coming up in terms of what we take out from here. But before we go, maybe, Beatrice, if you can give us 3 minutes, we get some 1 or 2 questions, maybe 2 questions burning, just so that we don't block everyone off. I promise, 2 minutes. Let me just, is that the only question? Super, it has been very effective. So 1 question, 1 minute.
Okay, good afternoon, very nice to meet you. Thank you to the panelists. My name is Max. I have a company here in Kenya which does mortgage and property brokerage. I help people find properties and get them financed so they can pay for them over time instead of paying all at once. From my feedback, I don't think the cost of mortgages is an issue. There are many people who are able to finance them. And you see that in Kenya, people love car loans, and car loans are very expensive, and they don't bring value because the value of the car depreciates. It's still, the uptake is very high. So I don't have the feeling that it's the cost of mortgages that is causing the issue in the offtake. Me personally, the issue that I have a lot is that developers do not want to sell to mortgage buyers. Either they say no mortgage buyer at all, or they say if it is a mortgage buyer, he needs to pay 30% upfront. So it's only for someone who has a lot of savings. Or they say, okay, if he wants to buy with a mortgage, it's 20% more expensive. But for me, what I've seen is that the most difficulty is to find developers who are happy to take mortgage buyers. So I'll be happy to see how the off-plan mortgage could work, because I think they will make a big difference in selling large amounts of properties to a large market.
Thank you, and that was a comment, so we are not going to respond to that. So thank you everyone for listening to us and not asking any questions.
Thank you so much, Johnston and your team. Please, if you're leaving, maybe you can do it quietly so we are able to continue to the next session. So the issue of informal incomes has come up in the previous session, and would like to unpack that further, which drives us to the next session. Kindly would have some silence. If you're walking out, kindly do so in silence and we can continue. Hello? Please, if you're walking out, please do so in silence. If you're staying, please accord us some silence and we can continue. Okay, that's much better now. Thank you for staying. So the next session, as I was saying, we're going to look at underwriting informal incomes, and we're just going to sort of carry the conversation we've just had forward. And we'll have the CEO of the Nigeria Mortgage Refinance Company, Mr. Kehinde, taking us through that session. He'll be joined by 2 panelists, Glenn Jordan, who is the co-founder of Empower, and Stephen Wanjala, who is the Executive Director of Housing and Development Finance Consultants Limited. Welcome to the podium. Just to mention, Mr. Kehinde is the AUHF chairman. Thank you very much, Chair, for taking us through that session. Kindly proceed.
Good afternoon, everyone, and thank you for staying to hear about this sector, which is extending the frontiers, especially for the informal incomes. I have two colleagues on my panel, and I think it's a reflection of the interest that people have in the informal sector. You saw the other panel was bigger. They had 6 people, which is conventional finance. But now it's the informal, and then it's a smaller panel, but I'm sure we'll do a good justice to this. The informal sector is a sector that accounts for 1/3 of the GDP in developing countries, and it employs 70% of the people. So it's actually a very, very big sector, but it's always overlooked for some reason because it's difficult to make an assessment or a judgment of what they actually do. And there are various definitions of informality, but the one I like the most is the one that says the informality is the production, market-based and legal production of goods and services that are invisible or hidden from public authorities for monetary reasons, institutional reasons, and things like that. So these are actually people who are working. They constitute 70% of the working population. But for some reason, either monetary, maybe because of tax evasion or tax avoidance, you don't see them, or because of regular bureaucratic systems that we have in place, you don't see what they're doing, or just because of weak enforcement and governance, you don't get to see these people. So this afternoon, we'll just be trying to unpack what the challenges are and the solutions to those challenges. But before I start, I just want my colleagues to say a little bit about themselves, introduce yourselves, your organization, and things like that, and we can get started. Thank you. Let me start with Glenn.
Good afternoon. My name is Glenn Jordan. I'm the co-founder of Empower, which is a platform to connect people to affordable housing finance opportunities.
I'm Stephen Wanjala. I'm the Executive Director for Housing and Development Finance Consultants. I work in the affordable housing space. I've been working in the informal sector for the last 30 years. So this is the space I've been in my whole entire career. Thank you.
Thank you. And just as an aside, I represent 2 organizations here. I represent AUHF. So for those who have not joined, we look forward to your membership. And I'm also representing my organization in Lagos, Nigeria, which is Nigeria Mortgage Refinance Company. So thank you for having us. Maybe I'll start with you, Glenn. What are the challenges with providing credit or financing to the informal sector? We have defined them as maybe some people that are invisible for some reason or the other. What are the challenges with doing that?
Thanks for the question. And it's come up so often in every panel today. It's come up about this informality of income. And to be honest, it's not that challenging to find them. It's more challenging to provide the finance for them. They come forward more unbelievably. One of the things that we found, just in terms of your definition of informality in Mozambique, is that if you provide a quality product at an affordable price, there is virtually unlimited demand. And a lot has been spoken about that, and that is the opportunity. The question is, how do we link that informality and those informal people to the providers of finance in such a way that addresses their needs? So we really need to look at both sides of the equation, and it's looking at that informality. What are their requirements? And the basic requirement for informality is to understand that their income is not static. And every product that we look at, the mortgage product by definition, comes from a background of formality. It comes from a background of formal income, salaried income actually. So it was a fantastic product when somebody got paid on the 25th of the month, a salary got paid into a bank account, and a mortgage could be defined on that. That is not the world today. That's not the world we live in. And unfortunately, it's taken some time for us to get to that understanding and for the financial institutions to get to grips. One of the first presentations today was talking about companies and the flexible requirements that they now have for office space. It's fascinating. So all industries are going through this challenge of less formality, less structure. And so everything that we need to do needs to be able to take that into account. Informal income is erratic. How do we create a product that meets that need? And then how do we report on that back to the financial institution in such a way that we can de-risk it for them? And that's the key to this process.
Thank you very much. I don't know, Stephen, if you want to add to that, just the challenges with providing credit or financing for that sector.
Just to add on that, looking at Africa and being real to ourselves, we have 80% of our economy is informal, which means who is dealing with this 80%? Let's not assume there is nobody dealing with that segment. There is somebody who is creative and he is responsive of what the reality is. And for this case, we have institutions that have been working with this market segment. And in this case, we know microfinance institutions, cooperatives are there serving the 80%. So if you think nobody's serving that segment, there is players serving that segment. So they're taken care of. So if you don't have that competence, it's the whole issue of how then do you leverage on people that have developed that competence. So the whole issue of collaboration. Thank you.
Thank you very much. Which takes me to the next question. I like the fact that you said that some institutions are serving that segment. But we also know that those institutions are challenged. Yes, they are, but they're not being optimally utilized. So how can institutions be encouraged or incentivized? So yes, microfinance institutions are playing there, but how can you incentivize others or encourage others or even increase the capacity of those microfinance institutions to even do more? Because yes, some of them are being served, or most of them are being served, but they've been served very well. And I want to piggyback on what Glenn said when he was defining. He said they want also quality product. So it's not just that they want something shabby, but something that is, so informality doesn't mean lesser quality and things like that, but how do you incentivize other institutions to come into that space, or those that are there to even do more? And I'm happy to have Glenn, maybe you start, and then Stephen can chime in on that.
Yeah, thanks for that. I think it's around information flow. So it's around collaboration, as Stephen referred to, but it's also around information flow. So the important part about informality is how do we get the information out of actually what's happening. So if somebody is paying, and there's been a lot of talk around today around rental payments are being made, but there's no recordal of that. And yet it's people's biggest expense, but there's no recordal of that expense. Can we cater for that? How can we capture that information in such a way that we can feed it into the formal financial institutions in such a way that it meets that need for them to be able to flow the funding through and collaborate with those institutions? Because I agree with Stephen, the institutions that we've got with the formal institutions traditionally don't meet that need and don't know how to get to that need. And so many times I've said in meetings where it's almost invisible. Literally, it's invisible, not just from information, but to the market perspective. And so I think that's a key part around that, is collaborating with people who do know and understand that market and can address it.
Stephen, you want to add to that? How do we incentivize others to play in that space?
Yeah, just to add on the same, I've just finished an assignment in Uganda with the Housing Finance Bank, is the largest mortgage lender in Uganda, which is a 54-year-old institution that requires a strategic decision-making. That as an institution, the traditional institutions that we have are wired to work with pay slips. That is the starting point. That's their DNA. So now you're telling them, can you serve a border? It's like day and night. It will not just happen. Then what my moderator has indicated, what is the journey that you need to walk to get this institution to change their whole DNA to work with a segment that they have never lent a dollar. Is strategy. And what does that journey look like? I'll just paint, because this is what I do with all commercial banks, trying to work with that journey of just making that transformational change. One, when you have a product, and in most cases this is where we get it wrong. You have your boutique product, you sat on your laptop, you think it's the most brilliant idea. We never ask ourselves, where will this product rest? How is that institution wired? Does it have the right place for the product that I'm expecting them to take on rest? So it calls for whole product development. And when you find product development in the traditional banks, it's not a cup of tea. In most cases, when you talk about working with that segment, it means going out and not sitting in the office. And that is the most toughest aspect. So going out and listening to that market segment, and they vary. When you talk to a border, his needs are different. You cannot use the same template of appraisal, please. When you talk to a Mama Mboga, it's a different business. It's not the same tool of analysis. So if you don't understand that business, whatever that you will be analyzing, you'd also just garbage in, garbage out. You think all businesses are the same, and your same analysis is all the same. No. That is what makes things look difficult.
Thank you, and I agree with that completely. I think
the needs on both sides. We've talked a lot around the informal market. What are their needs? Understanding that, getting out there, understanding the issues that they have to deal with on a day-to-day basis that aren't represented in this room. However, on the other side of the equation, we also have to meet the suits. We also have to meet their needs and know and understand what it is that they have to do, how we address their issues, what are their requirements in order to liberate that capital. And while there is capital available, we need massive capital. We need capital on a massive scale. How do we liberate that capital? We can only do that by providing them with the support and information that the capital needs in terms of the solution. So it's about linking the two together in such a way that we can address both sides of the equation.
Stephen, anything from you?
Yeah, I like this issue of collateral. And I come from a background that collateral is not what pays your loan. That's my starting point. Collateral is not what pays your money, brings money to your bank. It's about a character. And we talk that we lend because of character. And how do you analyze a character? And a character cannot be quantified. It's qualitative. And that skill of analyzing a character, that is what is the game changer, and that is what microfinance institutions have thrived to date, because they have perfected the art, because they know clients pay, because when they know what is this client they're dealing with. And it constitutes to 70% of the analysis. 30% is what is quantitative. Is this flipping the whole thing over?
Can I add to that?
Yeah, please.
The microfinance have also done something else. They start small. You don't start with a big loan. You start small. And it's the same basis of the starting small. We need to start small and build. And you build character and credibility. To add also to character is community. Again, we come from a Western background of finance, which emphasizes the individual. And community is such a key part around that. And the SACCOs and the other microfinance institutions understand that community is also a key part around character and support. And it's around local pressure. Again, this is why decentralization is so important. Local pressure on repayment to a centralized capital source is what's key to the success.
Thank you. And just to touch on that, I know you have a good example in Mozambique. Can you talk to us about the product there, this decentralization, and how you are working through that so that people can see that these products can be designed even for the informal sector and the outcome?
Yeah, sure. So Mozambique, as you know, is one of the poorest countries in the world. Beira is one of the most climate-impacted cities in the world. And so the product there is designed in such a way that the lease to own, the TPS as you call it here, is designed that there is a minimum payment, which is on a monthly basis. But contribution is done as and when money is sourced. So whether it's seasonal or whether it's a catch, as in our fishermen, our one customer is a fisherman, so whether it's based on catch season, that takes into account the reality of their income. The customer wants to own the home. So the repayment mechanism, putting it as a minimum repayment with capital contributions in finance speak, has enabled the customers to contribute, and they're already ahead of payments. So again, it comes back to risk. This market is perceived as highly risky. In fact, if we create products that are desired, like we're talking about, the reverse is actually true. It's not risky. It's just a question of how do we address that risk. And that element is, we needed data to support that, and we've now starting to build that data in Mozambique, which is a key element of that. The other part of that is the information back to the investor. We need to report that information back to the investor in such a way that we can attract investment in and provide the pricing mechanism and liquidity for the investor so that they are also not trapped for 20 years in terms of a mortgage, because that's one of the key issues in terms of attracting international investment, obviously, is international investment into Africa is perceived as risky. So how do we create liquidity around that? And that's the other side of the equation that we're addressing.
Thank you very much. Stephen, can you just, I know you are deep in this space, what are the current processes of underwriting by financial institutions in this segment? Just good examples for us,
The whole process, take it simply like one is there is alternative records that you look at, not the traditional financial statements that you will expect an audited financial to bring you. Those ones, you will never get them with this segment. So that one you pack. It's all about, for those ones who did accounts, it's about incomplete record keeping. You are constructing their records. So it calls for understanding of the enterprise that you are underwriting. So it calls you for vast knowledge of almost everything and anything if you are the loans officer doing the underwriting. So then it calls for what is the type of training that these staff are taken through to equip them to deal with this segment. That is the missing gap.
Thank you very much.
Can I also add to that? I think another element in terms of that is looking forward instead of backward. So much of our financial system is based on looking backward and proof of record, as we referred to, which doesn't exist, but it also implies that you have to come from money, which is why the rich get richer. So the whole thing around it is, how do we look forward? How do we create reputation going forward? And again, the TPS is a mechanism in which to do that, whereby if we can create individual credit records of payments that belong to the individual, not to a financial institution, that they can utilize going forward, we are creating credit histories for those individuals. So let's look forward. Let's create technologies and support for looking forward instead of looking backward, because that's what we're trying to do, is uplift and move forward with people who traditionally have not had funding or finance in the past. That's exactly what we're doing. So if we're expecting it, we're going about it completely the wrong way.
Thank you very much. Okay, I see hands going up now. I don't know if it's time to start asking. We throw it up into the audience. Sure. Yeah, okay. Who is moving around the microphone, please? There's the first gentleman there, the first question.
Hi, David Ross of Stratera Capital. So thank you both. It's great speaking with both of our panelists earlier individually, and the mention of utilizing the methodologies of microfinance in the housing sector. We see new non-bank financial institutions going into providing asset finance, and perhaps, but not as long of a duration as would be in the case of housing. And you mentioned it very, very clearly, Stephen, about character. What tools are out there when you meet a borrower, a prospective borrower for the first time, to assess his or her character? Are there a psychological test? Do you ask his or her pastor? And most importantly, how do you do it at scale to achieve the opportunities to reward the good parts of that 80% of informal sector that will do everything they can to make good on their credit? So I would love to hear any tools or resources that people are utilizing to find those starring, the people that should be rewarded for a good character.
It's a fantastic question. So maybe Stephen will go first.
Okay, so I'll go down memory lane where microfinance started, and that's where I started from. That's 30 years ago. At that time, there was no tech and there was nothing. And in the early 90s, you'll give $20,000 against no collateral whatsoever. How was that happening? If you look at $20,000 in the early 90s, how much would that be now? Just phenomenal amount. So one of the key aspects is about, everything is not about tools. It's about building relationships. A person will pay you because of the relationship. It's an art, it's not a science. I'll say so.
You want to take? Yeah, we'll come to you shortly. You want to take a stab at that?
So Stephen, maybe you're a little bit older than me, but I'm less traditional. Personally, I believe that we can develop tools, and I think around it comes to a question of exactly that, using the other aspects of microfinance. Because in order to get it to scale, we can't rely on relationships. So we have to build tools, and part of that is as I mentioned earlier, it's looking forward rather than backward, starting small and building to scale, and community, relying on the input of others around in the community to validate and support mechanisms, because that's the closest that you can get in terms of being able to take that to scale. And that's a key, those are the key parts around building decentralized systems that enable us to do that, to de-risk the process.
Thank you. Casey?
Thank you. I was hearing you, Glenn, you talked about that we need to come up with other ways of documenting people's financial habits. And it strikes me we are in the center of digital finance. And M-Pesa is everywhere. Can you not just use that?
There's certainly tools that you can do to use that, absolutely. Obviously, it's very proprietary, the information.
Why?
Because it's valuable, because it's extremely valuable. So the proprietary information is you can't get access to that information. So generally, it's very difficult to get access to that information. So really it comes down to then relying on other mechanisms, because that information is proprietary. And actually, that's one of the key parts, again, around decentralization, because that information should belong to the individual, not to the institution. Whether that is Facebook, or whether that is WhatsApp, or whether that is M-Pesa, or any of your financial information, it should belong to you. And again, that's one of the key things around what we're trying to do in terms of building that credit history, is to build a credit record that belongs to the individual, not to the institution.
Okay.
Just one little follow-up question, and I don't know if that's something you've explored in Kenya, but what are the regulatory issues around that? Is that actually possible? Because it seems this is quite a developmental issue. I mean, it's a critical issue for the development of financial inclusion, and there's a real opportunity here. So are there regulatory barriers to this?
From the top of my head, I would think that it also has some data protection questions around it. I don't know if you can just easily share information that you get from M-Pesa and use for your own analysis, but I don't know what the rules are here in Kenya. But if you look at the European General Data Protection and all of that, it makes it almost very, very difficult. So you have to, in my own assessment, develop those methods yourself, maybe gathering your own data and then making those informed decisions from your analysis. We'll go here now.
Hello, good afternoon. Thank you for your time. My name is Max. I'm into the mortgage brokerage business in Kenya. And when it comes to lending for housing for the informal sector, Stephen mentioned that the relationship matters. And I was thinking, all these people, they are renters today. And there's one person who knows them well, it is their landlords. Do you think there would be a way to work with the landlords for maybe the landlords to be able to sell to their tenants and then continue managing their mortgage payments and still collect fees for managing these payments? Because landlords know how to make sure this person pays. He's been doing it for the last maybe 5, 10, 20 years. They can continue doing it for the next 10, 20 years as well.
Stephen.
That will bring me now to another question. I didn't want to go there, but now you've raised it. I'll hint on it. Anything that you do, it has a model, and it has a way that you'll deliver that product. And every segment of your market, it will not be delivered the product in the same way, which rarely, when you look at most institutions, is the same. Where that differentiation, if it's not there, and you're working with the informal sector, it will be a big struggle. There has to be that differentiation of your model of delivery. Because the issue is not just giving the client money. That's a one-off, that is easy. There's the issues managing that facility for the entire period, which is the model of money M&E, which now that brings in now the whole cost of monitoring, makes the whole business how expensive or how cheap you are. So it's about the whole model of just disbursing, but also monitoring that facility.
We'll come back to it in 1 second.
Can I also just give an answer to that? Because I think, again, it's also around forward-looking. Because historically, it's around the forward-looking. What's the risk? If we do a TPS, what's the risk, actually, of the tenant coming in and not paying? The risk is that we have to move him out, and there's a cost associated with that. But again, depending on the environment, that is either relatively simple or quite complex. But that depends on the area that you're in, etc. So if, again, we start looking forward instead of backward, and we start saying, can this individual, what's his current payment, and is he paying that at the moment? Is he going to pay that going forward? Even the last 5 years, historically, it gives us an indication of how he's going to perform, but it's not a defining mechanism, because for his own home, he may pay it completely differently. So again, if we structure it taking into account knowing that he may have challenges financially, and to account for that, instead of punishing him for that, I always use him, her, because they're better credit. Better credit. The opportunity exists for her to do that going forward. If we can structure it in such a way that we build it going forward, we define the risk going forward, we reduce the risk going forward. And then instead of giving the funding to the individual, we're giving it to the institution who's incentivized. Another key part around this is aligning everybody's incentives. And right now, we don't have everybody's incentives aligned. And that's part of the challenge, and it's why we have that. If you think of a bank, the challenges that they have with deposits, and the legislation, I understand the challenges. It's challenging to lend to this market. But they are also incentivized to maximize the profit out of this. So they're incentivized to take what we can out of this sheep and maximize every piece that we can. And that's also not the right approach when dealing with this market, because we actually need an equitable approach. So how can we align everybody's incentives when addressing this market? And I think that's a key aspect.
Thank you very much. We're out of time, but we'll take your question.
Yes, thank you very
please.
much. My name is Matthew. I'm from NSF Uganda. I'm curious about, because the themes that I'm hearing are collaboration and data and guarantees and risk sharing. I'm curious about if there have been any initiatives where, let's say, SACCOs, savings cooperatives, as opposed to underwriting just the individual, you use that social group and his connection to that social group, and perhaps that social group would guarantee each member. Has that, as such, an initiative ever been explored?
Yes, those discussions, it hasn't been implemented yet. The discussions are underway, as are the technologies to support that process. So how do we create a mechanism? Because again, it comes back to how do we manage it? It sounds a great concept, but we actually need the tools to manage that process, and it's having the tools to do that in a way that we can take it, replicate it, expand it, and maximize it. So yes, to answer your question, yes, the discussions are underway. Is it in place yet? On our platform, not yet, but the discussions are underway.
Stephen, last one from you.
Yeah, just on that aspect, and this is always my theory of change when it comes to housing. Housing must be anchored on livelihoods. Like when you look at this particular entity that you are going to engage with, what are the economic activities that they're doing? That then when now you are coming now to structure the whole deal, it brings now those variations. Like I remember, just to give an example that you're saying, what is the model that has been done in Tanzania with one of the microfinance banks, and this is what we tried to do. It was with cashew nut farmers. So what this microfinance bank did, so it was acting like an aggregator. That's where now the creativity and innovation comes. So if you don't have the appetite for innovation and creativity, you miss a lot of opportunities. So it's seeing what is the opportunity ahead of you. So what this institution did, it went into partnership with a cooperative, which works with these cashew nut farmers. This microfinance bank was providing a housing facility. So it was acting as an aggregator, working with the manufacturers, getting the price of iron sheets at half the price, because it's acting as a guarant, as an aggregator. So there's a lot of creativity that when you look at the business opportunity and creating a value proposition for each actor, things can be done.
Thank you very much.
Thank
I've been
you.
told that we have completely run out of time. This discussion can continue afterwards. Thank you for your time, and then we are still available to talk to you. Thank you. Bye-bye.
Thank you so much for that session.